Hey there. A lot of people really dislike taxes, and it often feels unfair. You might be earning a modest income and still handing over a big portion of it in taxes, while at the same time hearing wealthy individuals openly claim they barely pay any taxes at all. Some rich figures like Robert Kiyosaki or Donald Trump have publicly talked about paying little or even no tax. That can leave you wondering how they can say this so openly. Isn't not paying taxes illegal? Why doesn't the government step in and force these wealthy people to pay more? You've probably also heard stories about individuals or companies getting arrested for not paying taxes. So what makes them different from these rich people who openly say they don't pay? The key is that wealthy people often use very clever methods to legally reduce or sometimes completely eliminate their tax bills. There are two main ways people try to avoid paying taxes: tax evasion and tax avoidance. Let's start with the first one, tax evasion. Tax evasion, also known as tax fraud, happens when someone breaks the law by not paying the taxes they legally owe. This usually means lying to the government about how much money they earned or hiding income, so the authorities don't know it exists. Tax evasion is illegal and can lead to serious consequences, including heavy fines and prison time. Let's look at how tax evasion works by walking through a few clear examples. The first method is underreporting income. This is when someone tells the government they earned less money than they actually did. Imagine Bob wants to buy a house from John for $700,000. If the tax rate is 10%, that sale should result in $70,000 in taxes. But to lower the tax bill, Bob and John agree to lie. Bob still pays John the full $700,000, but together they report to the government that the house sold for only $500,000. Because of this lie, they only pay $50,000 in taxes instead of $70,000, saving $20,000. This is clearly illegal because they are deliberately misreporting the true sale price to avoid paying the correct amount of tax. The second method is hiding assets. Hiding assets means placing money in locations where the government has a hard time finding it. In the past, Switzerland was well known as a tax haven. A tax haven is a country with very low taxes and strong privacy laws, which makes it attractive for people who want to hide their wealth. Normally, banks are required to share information about their account holders with the government so taxes can be properly calculated and collected. Swiss banks, however, were famous for their secrecy and historically refused to share account information with foreign tax authorities. As a result, if a wealthy person stored money in a Swiss bank, their home country often had no idea that money existed. Here's an example of how that worked. Suppose Tom, an American, earns a large income, but doesn't want to pay high U.S. taxes on it. Tom opens a bank account in Switzerland. Because Swiss banks kept account details confidential, Tom doesn't report this income to the U.S. tax authority, known as the IRS. By hiding his money this way, Tom avoids paying taxes on it. This is illegal because he is deliberately concealing income and lying to tax authorities. Today, however, this strategy no longer works the way it used to. Many countries pressured Switzerland to change its laws and start sharing banking information with foreign tax agencies. Now, if a wealthy American tries to hide money in a Swiss account, the bank reports it to the IRS, and that person could face arrest. The third method of tax evasion is false deductions. False deductions happen when individuals or businesses exaggerate their expenses to make their income look smaller, which lowers the amount of tax they owe. For example, imagine Sarah owns a pizza restaurant and earns $100,000 in revenue. Governments allow businesses to deduct legitimate expenses so they can reinvest in growth before paying taxes. Instead of taxing Sarah 20% on the full $100,000, which would be $20,000, the government allows her to subtract business expenses first. If Sarah truly spent $30,000 renovating her restaurant, she would only pay 20% on the remaining $70,000, which equals $14,000. But Sarah wants to keep more money, so she cheats. She only spends $3,000 on renovations, but falsely claims the expense was $30,000. Because of this lie, her taxable income appears to be $70,000. She ends up paying 20% of $70,000, which is $14,000, plus her real renovation cost of $3,000. In total, she only spends $17,000, even though she should have paid much more if she had reported everything honestly. By exaggerating her expenses, she lowers her taxable income, pays less tax, and ends up keeping $83,000. If she had been honest and actually spent the full $30,000 on renovations, her total cost would have been $44,000, leaving her with only $56,000 afterward. So the key point is this: Sarah, who was supposed to spend $30,000 on renovations, spent just $3,000, kept the remaining $27,000 for herself, and then lied to the IRS by claiming she used the full $30,000 to reduce her taxable income. To sum it up, tax evasion involves illegal actions that break the law and can lead to serious consequences. That's why it's important to understand that these methods are not something you should ever try yourself. That said, there is a legal way to pay less in taxes, and that's called tax avoidance. Section 2. Tax avoidance. Tax avoidance is about legally using smart strategies to reduce how much tax you owe. It's essentially finding loopholes, deductions, and credits that are built into the tax system. Unlike tax evasion, which can result in fines or prison time, tax avoidance is seen as clever and lawful financial planning. Instead of breaking the rules, you're simply playing by them in a way that allows you to keep more of your money. Let's look at how tax avoidance works through a few clear examples. The first strategy involves something called controlled foreign corporations, or CFCs. A CFC is a company created in another country where taxes are very low or even zero, often referred to as a tax haven. By setting up a business there, companies can shift their profits to that foreign entity and avoid paying higher taxes in their home country. A well-known real-world example is Apple, the same company that makes iPhones and other popular devices. Apple managed to avoid paying an enormous amount in taxes, around $44 billion over just 3 years between 2009 and 2012, by using shell companies. One of these early shell companies was called Apple Operations Europe, based in Ireland. Even though this company had no employees, it played a massive role in Apple's tax strategy. So how did this setup actually work? Irish tax law determines a company's tax residency based on where it is managed and controlled. U.S. tax law, however, looks at where a company is incorporated. Apple exploited this mismatch between the two systems. By incorporating the company in Ireland, it avoided U.S. taxes. At the same time, by managing the company from the United States instead of Ireland, it also avoided paying Irish taxes. The second tax avoidance strategy is called transfer pricing. Transfer pricing happens when a company shifts money between its subsidiaries in different countries. It sets internal prices for goods, services, or intellectual property in a way that pushes profits into countries with lower tax rates. This allows the company to reduce its total tax bill. For example, imagine John owns a company called Wee Shoes Corporation in the United States. His company launches a new shoe model and earns $1 million in profit. If the U.S. corporate tax rate is 35%, he would normally owe $350,000 in taxes and keep $650,000. Instead of paying that high tax rate, John decides to use a tax haven like the Cayman Islands, which has a 0% corporate tax rate. He creates a subsidiary there called Wee Shoes Cayman Islands Corporation and transfers all the company's patents and copyrights to this new entity. When the U.S.-based Wee Shoes Corporation sells the shoes and earns $1 million, it claims it must pay $800,000 to the Cayman Islands subsidiary for using the brand's patents and intellectual property. That leaves only $200,000 of profit in the U.S., which is taxed at 35%. As a result, the company pays just $70,000 in U.S. taxes and zero tax in the Cayman Islands, keeping $930,000 after taxes. This strategy saves John $280,000 in taxes. However, there's a catch. John can't simply bring that $800,000 back into the United States without triggering taxes. So what can he do? He can reinvest the money overseas or wait for changes in tax law. For instance, in 2018, the U.S. corporate tax rate dropped from 35% to 21%. If something like that happens again, John could bring the money back at a lower rate. If he repatriates the $800,000 at a 21% tax rate, He would pay $168,000 in taxes and keep $632,000. In the end, John walks away with $762,000 after taxes, compared to just $650,000 if he had paid the original 35% rate. The third tax avoidance strategy involves dividends. As mentioned earlier, Warren Buffett, one of the most successful investors in history, pays a lower tax rate than his own secretary. How is that possible? The reason is that most of his income comes from dividends and long-term capital gains, not from a salary. Dividends and long-term capital gains are taxed at lower rates than regular income. For example, a $100,000 salary might be taxed at around 22% to 24%, while $100,000 earned through qualified dividends or long-term capital gains may be taxed at only 15%. This favorable tax treatment allows Buffett and many other wealthy investors to pay significantly less tax on their investment income. In short, tax evasion means illegally avoiding taxes by lying or hiding money, while tax avoidance means using legal strategies to reduce or even eliminate tax obligations. Tax evasion is dangerous and illegal, but tax avoidance can be a smart and lawful way to manage your finances. It's also worth mentioning that some strategies people call tax avoidance are actually tax deferral. Tax deferral simply means postponing taxes, not eliminating them. You still owe the same amount eventually. Examples include contributing to a 401k, using 1031 real estate exchanges, or investing through IRAs. These methods delay taxes until a later date, whereas true tax avoidance aims to permanently reduce the total tax bill. If you'd like me to make more videos breaking down topics like this, don't forget to like and subscribe. Thanks for watching.